Welcome everyone to another episode of Financial 15. Kevin and I are ready to go. And you can see we have a guest. Adam Buss is joining us, special guest. We're talking mortgages, interest rates, what's the impact, lots of great information. You'll want to stick around.
Yes, our first Financial 15 video with a guest speaker. Adam Buss is with us from the home office in St. Andrews today. And again, if you want more information on any of our videos, please subscribe to our YouTube channel. It's really quick and simple, easy to do, great content there. Or if you can, like us on Facebook. And most importantly, visit our website at beckerorr.com. We have everything you need there financially. We also have the back and forth and anything along those lines. But today we are talking mortgages and rising rates, what's going to go on, which is why we brought the specialist in. Clint, what do we have for Adam today?
Oh, we've got a couple of questions from clients, and people have a lot of questions in this particular environment. Rates are going up. Homes are getting a little cheaper. The prices are kind of stabilizing, but lots to tackle there. And we're going to start off with the first one here for you, Adam. We're going to talk about the rising rates, talk about trends in interest rates.
Sure. I mean, we've gone through a period over the last 2 years, especially where money's been super cheap. I mean, people are paying, a 1.5% of their mortgage, and that's certainly not the norm. That is not something that we can expect on a regular basis. That would be the norm that people can expect for mortgages. So those who kind of snag those deals during those time are certainly laughing today, as 5-year fixed rates have climbed north of 5% at this point in time. So certainly a big difference that's kind of happened in the last 2 years. So the 5-year fixed rates have certainly skyrocketed quite a bit, along with the 1, 2, 3, 4 years as well. And right now the variable is kind of lagging behind. So there's certainly a bit of a differential when it comes to the fixed rates. So the fixed rates do follow a bit more of the bond trend. So right now, a lot of the anticipated rate hikes, have maybe already been priced in to a lot of the fixed rates, which is why they're dramatically higher. There's at least around a 2% spread these days between the 5-year on the variable close product. That's a big difference, right? So if I'm trying to decide, do I want to go variable or fixed, which is certainly a common question, that's a big difference right away from day one on the interest charge that you have to pay on your mortgage payment.
Yeah, that's huge.
Into the next topic there, Kevin, as well, right? The fixed versus variable.
Yeah, that's exactly it. I mean, which do you do? Do we go fixed versus variable, or is it a personal choice? How do we make that sort of decision, especially after you've mentioned a 2% spread, the way things are going?
Well, there's certainly a big difference. There's the dollars and cents comparison, right? Which is, okay, if I'm going to go with a fixed rate, I know that from day one, I am going to be paying a higher mortgage payment right away because I am paying a higher interest rate. And that's guaranteed to continue that way for the next 5 years. Versus variable, you're going to start at a lower interest rate, and then all likelihood, based on what the Bank of Canada is forecasting, I mean, it will go up, but will it go up to that same percentage as of what you'd pay from day one on the fixed rate? Who knows? I don't have a crystal ball. If I did, I'd make a lot of money, but right now I don't have one. So that would certainly be a deciding factor. Is are you up over time? Knowing that, yes, we are in a bit of a rise in interest rate environment, and that is in all likelihood going to go up on you.
I guess it's a personal choice.
It is very much a personal, just like investing in the market. I mean, everybody's got a different comfort level. Everybody's got a different risk tolerance when it comes to a bit of the unknowns that it presents. So some people just like that peace of mind and taking that fixed rate, knowing that their payment is not going to change along the way. I ran some quick numbers just to give you an idea as to what it is. So let's say there's a $500,000 mortgage, which is certainly not outside the realm of possibilities these days.
Not today.
Not today, right? So the difference between the current fixed rate and the current variable rate is over $660 a month in payment.
Wow.
That's just on the interest rate difference. So that is a big difference from day one on the mortgage. So some people might say, I'll risk it. I'll go with the variable, and I know I'm not paying that immediately, but in all likelihood, it could creep up to that same point along the way.
Wow. And that's over a 25-year mortgage in those numbers? Is that what you
Yeah,
use?
it's 25-year mortgage, 500,000 at the current approximate interest rates. I won't go through them because they change on a regular basis these days, and
Hourly.
they might be outdated by then. So
Oh, okay. And that leads to the next topic that we frequently get asked about is rates are going up. You mentioned the trend, you mentioned fixed versus variable. It could mean all the changes that could come to payments. And that's often a concern for folks that are looking at a mortgage or have a mortgage. Any comments on that, Adam?
yeah, so fixed rates, I mean, you're locking in your payment. So you get the peace of mind knowing that your payment is not going to change whichever way the wind blows on that particular day. It is going to be that amount for the time period of your term,
Mm-hmm.
1 year all the way up to 5 years, unless you're locking in longer than that. So that's a guarantee that you don't have to stress about. On the variable side, your financial institution likely will raise your payment when interest rates increase. So you'll get a letter, you'll get a notification saying, okay, your new payment every month or every 2 weeks is now X because interest rates have gone up. So there is slightly more payment variability or unknown as to how your payment could be impacted. If you are taking the variable, you could choose to set your payment a little bit higher than what the mandatory payment is as well, just
Mhm.
to pre-price it into your budget
Mm-hmm.
and expect that payment is going to change along the way, and then you might not see the impact as dramatically on your end.
That's
Yeah.
perfect. Yeah, and I mean, definitely. I mean, pre-booking some of these things, I guess now would be more of an advantage to be able to take right now, as opposed to waiting until you actually have the home.
For sure, yes.
Yeah. So I mean, basically, as we've talked about some of these other things, this is going to have an impact on purchasers no matter what. But I guess it depends on what's your cash flow, what's your budget, and everything else, as opposed to how it's going to impact purchasers on buying new homes, as opposed, variable or fixed, whatever the case may be.
Yeah, everybody's got a different budget, and when it comes to mortgage approvals, I mean, the bank or your lender, your broker may be trying to say you're approved for the maximum of X, right? But you still have to
Mhm.
know that you can afford the payment for that particular mortgage amount, right? So buying at your
Yeah.
max is not always the best decision for you financially when it comes to a cash flow perspective. However, in today's market, sometimes you have to kind of go towards is understandable. But when it comes to the pre-approval process, certainly make sure that you have re-reviewed your pre-approval, since a lot of the interest rates have changed quite dramatically, which does actually change the pre-approval process. So a couple of
Oh,
years ago, the government put in the stress test for mortgage approvals, where you had
yes.
to get approved at the current stress test rate is 5.25%. So even though you might be paying, last year 1.5% on the mortgage, you had to qualify based on 5.25%, which everybody at that time thought was ludicrous because no way rates are going to reach 5.25%. How the tables have
Right.
turned, right? Um, but now the stress test is still 5.25. However, it is either your contract rate on a fixed rate mortgage plus 2%, or if you're taking the variable, it's either the contract plus 2% or 5.25, depends whichever is higher. So
Oh, okay.
if you want to get approved for a mortgage, you might still get approved, but you are forced to take the variable because that's the only one you can meet the stress test requirements for. Versus on a fixed, now instead of qualifying at 5.25, you might have to qualify at over 7% just to afford that same mortgage.
Yeah.
So that can really eat at your purchasing power when it comes to buying a house. I ran a quick example. So let's say a year ago, somebody got pre-approved for a $500,000 purchase. Nothing in their financial situation has changed since then, except the interest rates have risen and they still want to get a fixed rate mortgage. Now,
Hmm.
instead of 500,000, they can only be pre-approved for 420,000.
Wow.
So that
Yeah.
is a big difference that eats away at your purchasing power. So even if the housing market does start to cool, your purchasing power has also decreased as a result of the rates changing and the burden on your cash flow.
Yeah.
So
Substantial.
the affordability equation there, unfortunately, isn't improving, is what you're saying. Now, the house prices, maybe they cool, maybe they come down a bit, but it's now still more difficult to buy a home because what you just talked about in terms of purchasing power.
For sure. I mean, there's ways to make sure that we're selecting the right product. So discuss with your mortgage broker, mortgage specialist, your financial institution, make sure that you're getting the right advice to find the right solution so that they can try to get you into a house as soon as possible.
Wow. Okay, well, I appreciate the topics here. We have one more for you here. Again, common questions we're getting as rates are going up, and it relates to mortgages, relates to houses. This may be a little closer to folks that already own a home as opposed to those trying to get into a home. But the idea of refinancing. Now, when rates are dirt cheap and you have equity in your home, it's often a no-brainer, but a different scenario today. So what are your topics or your thoughts on that topic?
Well, you're going to have the same in a cheaper interest rate a couple of years ago. Now that product is coming due for renewal and you're faced with these, dramatically higher rates than what you were previously locked in for. And you have that same debate. Should I go fixed? Should I go variable? Again, it comes down to that personal preference, knowing that your payment is also going to increase as a result. So even though the total time period remaining on your mortgage hasn't necessarily changed, the interest rates have, which causes your payment now to go up at renewal. So that's certainly something that you need to prepare for as part of your budget. Refinancing to try to consolidate debt, when it's maybe still a higher interest rate environment, maybe doesn't make as much sense. Depends what you're paying on some of that other debt. I guess if it's credit cards or whatever, that still might make sense. You're certainly saving some money there. But if you're just trying to consolidate a few other consumer loans, different than what you'd be paying on the mortgage side of things. But again, everybody's got a different financial situation. There's certainly not a catch-all advice piece for that. It's just get the right advice, talk to your advisor, and again, make sure they find the right solution for you.
Yeah, so one way or another, we're basically getting into a theory where beforehand we never really worried about it because money was cheap, but now that money's not quite cheap anymore, this becomes a bigger situation that you really have to review. And I think that causes more for people to take a look at going forward. But again, if you have any questions that you want to ask for Clint or I, or if you want us to get in touch with Adam for it, please go to chatwithclintonandkevin.com, and we would be more than happy to make sure that we answer the questions, or we'll get Adam to answer the question directly for you on mortgages, on rising interest rates, insurance, financial planning, the whole 9 yards. Please consult, and we're going to do everything we can to make sure that you get the knowledge that you need. Otherwise, Clint, do you have any final closing comments for our special guest for today?
This is a lot easier when you have a guest, Kevin. So I think we have to do this going forward. Less burden on us. All the knowledge coming from Adam today. But we'll leave it there. We appreciate everyone tuning in. We'll be back again soon with another video. Take care.